liked your voice, and I liked the introduction which you gave about the Taxmann. And I'm sure everybody of us are associated with Taxmann somehow or the other, in some or the other aspects of the life. So thank you, Taxmann, for giving this wonderful platform for sharing knowledge and sharing a lot of informations which are useful for practice. So with this, let me start today's topic, which is ESOP. Today, what the whole objective of designing this particular presentation was mainly because a lot of new instruments, even in its ESOPs, have been introduced. And these new instruments are something which is very popular in the startup world. A lot of startups have started subscribing to these new instruments, and therefore it is very important for us also as an audience to know that, okay, what are those instruments all about. With this, I would also like to share that today there are some of the questions which I'm going to put it on the platform, on the group, mainly to understand that, okay, there are gray areas also which are there in this new instrument. So these instruments are not very clean and clear, but of course these instruments have certain gray areas which requires to be addressed, which of course will be addressed as it gets mature. Right. With this, let me take you to some of the glimpse of it, some of the very important basic principles of ESOPs, which I'm sure everybody are aware of. But what I'm going to do is I'm going to just share this so that we are aware about at least the basics, right? Okay, just give me a second. Yep. So, basically, ESOPs, of course, as we all are aware of, ESOPs are available for all the employees, directors, whether they are in India, outside India, subsidiary, holding, etc. Some of the people whom ESOPs are not provided are independent directors, people who are the promoters of the company, or people who are holding 10% and more of the equity shares because they are already the holder of the shares, and therefore they are not allowed for ESOPs. Of course, there's one exemption which is available, which is mainly for a startup companies, which is up to 5 years of incorporation. When we go to SWET, basically SWETs are mainly designed mainly for employees and directors who are there with an organization for a year or so. There's a lock-in period in SWET for 3 years. And in case of ESOPs, of course, we are aware of there is a vesting period. After vesting, we exercise it. And then, of course, if we want to sell, then we sell it. That's the plan. When I talk about equity versus sweat equity, valuation plays an important role, because when we look about ESOP starts with a journey from grant, wherein you value a particular ESOP, right? And we also design and determine that, okay, what is going to be the exercise price which the employees are going to pay. So that exercise happens at a prior stage when the ESOPs is launched, and the grants are valued by the registered valuer. When it goes for exercise, it is valued by either if it's an unlisted organization, then it's valued by merchant bankers. And if it's a listed organization, of course, that is available on the exchange. When it goes to SWET, the valuations are being done by the listed organization. So if it's listed, merchant banker. So generally what happens with SWET? So SWETs are basically when any intellectuals is bought by an organization, where any director of the organization or any new introduction happens, which is very capitalizing for the company. Now, such kind of instruments are always used for this purpose. So when I onboard some new technology, or I onboard some new intellectual person into the organization, of course, then the SWETs are used. So there's a valuation which is done for an IPR, which is done by the registered done by the merchant bankers. If it's something related to shares, then of course it is done by the registered valuer. There are some limitations in issuing the SWET. So you can issue the shares to the extent of 15% of the capital. And the issue price should be less than 5 crore. If it's an overall limit, which we talk about, then the overall limit is going to be 25% of the capital. So we can't go beyond that. That's the restriction which is there. Again, over here, there is some exemption which is available for startups. So startups enjoys this benefit because they are, by the name themselves says that they are having a liberty to grow the Indian economy. right? Going forward, taxation broadly, ESOPs are being taxed at the time of exercise. We are aware about it, and SWETs basically are taxed at the time of allotment of the shares, right? Now, this is a new instrument. By and large, it's new. People are aware about it, but of course, we will be discussing in detail about this new concept. So, this concept is talking about community stock option plan. There are teacher stock option plan, which is ESOPs. Then there are merchant stock option plan, which is known as MSOP, right? So then there are multiple such varieties and some innovations which have come up, but broadly by and large they are talking about in the same sense. So therefore we are going to discuss today about the community stock option plan, of course, which can be extended further for MSOP, TSOP, etc. Right? What are the benefits which are there in terms of CSOPs? Let's go into it. The benefits are basically when a startup, right, at the initial stage of their funding, when they are looking out to raise a fund, right, this kind of a community stock option plans helps a lot to them, because there what happens is you are actually not issuing the equity to them, but at the same time you are entering into a contractual binding with the investor, based on which the investor gets that comfort, and therefore he does the seed funding, right, or a pre-seed funding stage, whatever stage they are at. So there is going to be an investments which is going to come to the company, which is a startup company, and startup company contractually enters into an agreement wherein they will design certain paybacks. They will design certain strategies based on which the investors will be getting their paybacks, right? So that is a efficient agreement is one of the advantage which is there as a flexibility for for the CSOP. Access to the growth stage of startups, of course, because there are multiple levels, pre-seed, seed funding, etc. So different levels, the ESOPs can be utilized. Financial protections for the investors, because there's a very watertight agreement which gets entered into between the investor and the company, and there's a kind sort of a mini exchange which is getting created, which becomes a third party confirmation. So there's a financial protection over here in terms of it's a direct investments into startups. So it's not through a VC, etc., but it's a direct investment which goes to startups. Information rights. So you are allowed to have the information about the company. Being an investor, you get to know all the informations which are there in the startup which is going out where you have invested. Some of the disadvantage, of course, you are not into the cap table of the company, so you are not enjoying the benefit of capital being as a shareholder, but you act as an investor. Mandatory stock option call options. So generally, by and large, what happens is startups enters into an agreement wherein over a span of years, when a particular value is reached and the startups reaches to a particular value, at that point of time, there is a mandatory call option. So that is already decided at the pre-agreement stage itself that this is going to be, for example, let's just to say as in part of an example, let's say at the 10x of the value, or maybe 50x of the value, you will have to mandatorily exercise the call option. So that's kind of an agreement which is agreed between the investor and the company. No voting rights, yes. And secondly, the strategically currently, maybe not strategically, I would say, but at least from the format in which currently this particular ESOPs are accounted for and taken into consideration, there is a formal GST which is supposed to be charged. And as an individual investors, if I am being a part of it, then I am losing over there. Just give me a second. I just want to check whether you are all are able to hear me out or not. Just give me a second. Guys, are you audible to me? Is anybody can please give a thumbs up or thumb up, or can you just give me a reply whether you've been able to hear me out? Anyone? Okay, great. Thank you very much. Thanks for 3 replies, which I'm able to have. Thank you. Okay, going forward, there is, as I said about GST, if an individual who is not being into a business, when he is being charged GST by the startup companies, in such scenario, what happens is that individual is not able to take the credit. But then what makes them to take this decision? Because at the end of the day, if it is 18% GST, then that's a big cost, right? Of course. But then what happens is there is a arbitrage call which has been taken by by the investor, because they are able to see a longer growth in terms of valuations, etc. So therefore, they are ready to bear this particular cost, and therefore they come forward for investing. Secondly, when this kind of investments are made, at least right now, when it is still maturing, investors generally invest with a small ticket size. Therefore, they are not much worried about the GST credit. That's the reason they are coming forward, right? Taking it forward. Now let's understand that what is this CSOP versus SAR. So SAR is stock appreciation rights, which has been there since ages, and we have been aware of, we have heard about it, we have practiced in it, and there are so many things which we have done for that, right? So SAR is a concept which is already there, and therefore what I have tried to do is I've done the comparison between SAR versus ESOP or CSOPs. Now let us see that what is it. It says subscription to this option. Now, generally what happens is when I am using the word cash, it doesn't mean literal cash. What it means is that it is through a banking channel. So CSOPs are generally issued in a form of, so what happens is an investor invests into a company, a startup company, right? And he gets in turn the commitment from the company for subscribing for this CSOPs. Whereas SAR is basically an option which is allotted mainly from the perspective of share appreciation rights. So any person who subscribed to SAR model, they generally enjoy the benefit of appreciation in the price of the shares, which they may get in future. And that is something which they enjoy it, and they get the benefit of that, for which they do the subscription. CSOPs again is on the same parallel lines, is where you are actually investing into a startup, right? And when you invest into a startup, the objective, the backend objective is that once the startup grows, it arrives at a value, and then you get the benefit of that value. So there's an appreciation which you want to enjoy, and with the same objective, you enter for CSOP. Exit basically formulas are something which is predefined, generally, as I said, 50x, 10x, etc. And that is what is agreed at the agreement stage, at a contractual stage, and that's how this particular investments have been taken. In case of SAR, of course, it is dependent on the markets, and the price is determined by the market, and at that differential price, you enjoy the benefit. That's what is the difference between C and S. Taking it forward, there is investor-investee relationship. In here, it is employer-employee relationship, or maybe a contractual relationship. So either of it is available for SAR. In terms of liability, basically whether this investment which is made by this particular investor, okay, whether that amounts to a liability for the startup world, that's a question, right? That's a question. Now, what happens is generally, when by and large, when we see the agreements generally don't speak about the contractual liability, or it doesn't speak about a commitment for repaying the investors. It's basically kind of equity oriented flow, wherein the funds are coming in without any commitments from the startups, from the investors. Startups don't give commitments on repayment of those particular investments, because they are by and large with an objective that, okay, if the valuation increases, if the startups booms back, then in that particular case, they will be beneficial. So therefore, if your contractual agreement is termed in non-commitment format, then of course it is not a liability for the startups. In case if it's a binding agreement, then in that case, of course, it will lead to a liability, right? That's the kind of a differentiation. In case of SAR, of course, there are accounting standards, NDAs, which guides it, and that's how we have to follow, right? So we under SAR, let me tell you, we make a provision. So there's a specific provision which we make on a regular basis for SAR, and that's how we book the provisions in our balance sheets, right? Because there's a commitment which we go ahead when there is an appreciation in the price. Valuation cap, as we spoke, we have discussed about it. Cash flow, basically, there is a capping, as I said, 10x, 50x, which is just repeating over here. Regulations, it is by a contractual agreements, therefore it's a contract act which would govern over here. And when you refer to SAR, basically it's a SEBI law which talks about it. This is an important point, cash flow. So whether it will be considered as revenue or whether it will be considered as liability. So that's something, a question which depends upon the contractual part. But in case if there is no commitment, let's assume for a minute that there is no commitment from the startup company where I'm making an investment. In that particular case, that becomes the revenue for that particular startup because it's not a contractual liability. Now I can correlate this with somewhere like a lottery company, a company which is issuing lotteries, right? So what happens is when the lotteries are issued, basically for the company, when whoever buys those lotteries is a revenue for that particular company, right? At the later stage, when the lotteries are actually plugged, and there are some lucky people who are being refunded the money. Of course, here the situations are different. Here, what happens is the investor makes an investment into the company. Once these investments are made in the company, then if the company grows, then all the subscribers of the investments gets benefit of it. So it's like you are lucky to if the startup grows. Okay, if the startup grows, then you all are lucky, and then everybody gets the benefit of it. But what I'm trying to just connect is basically in a lottery business also, when you see the company does not give any commitment of liability for all the subscribers, right? It is only for the lucky one who enjoys the benefit. So there also, when you subscribe it and when you subscribe that lottery tickets and when you pay for it, that becomes a revenue for the company, and a company of course discharge the GST liability out of that. So it becomes a revenue for them, and subsequently whenever that particular money is paid to the lucky people, then it becomes an expense for them. That's how they treat the accounting in their books. So I'm correlating it with that. And here also because if there is no specific liability mentioned in the agreement, then it is the same accounting treatment which needs to be followed, right? Moving forward, this is a chart which gives a holistic view about what each of the instruments are talking about, and what are the features of each of the instruments. And people who wants to take the screenshot of it, of course they can do that, because it will be helpful for them to take this particular as a reference guide for their future, right? When we go to ESOPs, as we spoke, it's an option for gets converted into equity at a future date. It's a conditional allotment which happens. No cash flow at all. So initially you don't have to incur any cash flow. To employees and directors to retain them. And P&L is basically where what happens is you arrive at a grant value. So at the grant date, you arrive at a particular value, and you also decide what is the exercise price which you are going to recover from the employees. So the differential value is something which is supposed to be proportionately allocated over the vesting period. Over the vesting period, and that's something which happens to the impact to a P&L. Tax on the exercise dates to the employees, and fair market value is basically the exercise price date is what excess price and the exercise date is what has been considered, right? Sweat equity shares to employees at a discounted price, maybe including directors, etc. Direct allotment, there is no conditional allotment. You directly make an allotment. There is a lock-in period, which of course I have discussed in past. Shares can be sold by employee after the lock-in period, right? Acquired, this is one of the objective is to acquire intellectuals, and fair market value is of which is impacted to the P&L. When you go to SAR, compensation is given through the employees for their appreciation. So appreciation is the objective, and the benefit of that share appreciation is something which is given to the employees. No equity dilution. So because it is not a equity portion which is handed to the people, to the subscriber, it is just a commitment in terms of stock appreciation, which is encashed over a period of time. That's the reason why there is no equity. Mostly issued by listed companies, since fair market value is readily available, because otherwise that becomes one of the challenge as to what should be the price which should be considered for the purpose of stock appreciation. So that's the reason why mostly it is being favored by the listed organizations. Can be used to pay vendors and consultants at times, because if you want to have a loyal vendors or loyal consultants with you, and therefore if you want to give this commitment, then of course there also this has been used. Largely it's employees have been using it, but yes, this is a window which is open for them too, right? Moving forward, impact to PNL, of course, each reporting year when there is a price adjustments which happens because of the year end, so that is something which is considered as a part of PNL, so that you bring it to the PNL. Differential value is something which is taxed. So let's say when I subscribed, the price was 1,000 bucks, and when I actually came out as per the scheme, there the price was, let's say, 3,000. So differential 2,000 is something which is going to be considered for taxation, because of course that's the income. Now we go to the next one, which is phantom shares, going out very popularly. A lot of consultants also are subscribing to phantom shares. Largely, phantom shares is in a form of SAR, where it's a stock appreciation. So this is very heavily used by used by the startups, mainly to enter into an arrangement with consultants, where they want to have their commitment, but they are not able to have cash flow at the initial stage, and therefore they enter into such kind of a phantom commitments, right? No initial cash outflow as shares from wealth creation. So there's no outflow, as we spoke. Can be used to pay vendors, consultants, and the differential portion is something which is discharged to the profit and loss account. Now here also what I have been seeing is, in the practical world, there is a lot of promoters who at an individual capacity, from their commitment as a part of their personal commitment, they give it to the consultants. So they don't give company as a party to pay this particular liability. They individually take it as a liability from the valuation which they are going to generate at the future end. So that's their personal commitment as a promoter to the consultants. In that case, of course, the company is not getting impacted. But in case if it is through company, then of course company will also come into picture, and therefore they will debit it to the P&L account. Now, when we go to CSOP, basically CSOPs is talking about that the shares, the shares, there are no shares which have been issued. It's a kind of an investments which has been done by the investors. No equity, basically. Initial cash inflow to the company, used for acquiring investments. So kind of likes of crowdfunding is something which this particular instrument is used. It is initially booked as, so if it is not, as we spoke about liability, if it's not through liability, no commitment, then it is a revenue at the initial stage and expense at the later stage. Taxation in the hands of investors is going to be at the time of redemption, of course. And the point is whether this redemption, whether the initial investment value, whether it will be considered as the cost or not. Of course, that's a question which we need to deal with, because when we go to VDA, of course, now they have allowed the cost, but nothing beyond cost is something which is allowed. Therefore, they have come out with a new classification for VDA, where basically a basic cost is something which is allowed. So if I go on the same lines, yes, the cost should be allowed. But in case if suppose there won't be anything beyond that which is allowed, or indexation, etc., is allowed. But that's something which is not clear right now, and therefore I have marked a question there. Now moving on to the next part of the agenda is basically trust root, how it functions. I've just shown it over here. The trust root functions wherein a company incorporates a trust, which is basically an employee welfare trust, where they lend money to the trust trust by that funds generally subscribe to the shares of for the ESOPs purpose, and then they enter into a commitment, and based on that company parks certain amount of shares for this ESOP scheme, which is then given or issued issued to the employees who are satisfying those conditions, and then the company issues them the shares. When the employee exercises, it pays the price to the trust, by which the trust repays the loan which was given by the company at the initial stage. So you are able to see it from the diagram, and point number 1, 2, 3, 4, 5, 6. So that's how this particular transaction flows. So what happens if I go one more recap of it? Company A would make the payment first to the employee trust, welfare trust. Trust will make subscribe for the shares, right? So it will be direct issue of shares. The shares will be on behalf of the trust. Employee later on, let's say if they want to, so they are eligible for it, so there will be an options which will be given by the company to the employees. Employee, if exercise the options, they will pay it to the trust. Trust will in turn make the payment of loan. So whatever loan they have taken at the first stage, they will go for the repayment of that. That's how this whole exercise will happen, right? Now let us go to the taxation implication of this, and we understand some of the questions, and I'm going to spare some time, but when we go into it, we need to really be very clear. Today, what we are going to discuss are what are the questions which come across in such kind of instruments. I may make a statement over here that there are certain places where still it is not very clear as to what should be the tax implication on this, but we can at least have the discussion on this particular part, right? Now, first question is, what is the tax implication on preferential allotment to the consultants? Right. So let's say if suppose a consultant who is entering into a startup world, he is looking out for commitment with the startup, but at the initial stage, because he is not an employee, he may not take to equity to the sweat equity. But he, if taking in preferential allotment, right, because he is also a shareholder, if he takes a preferential allotment at the first stage, what is going to be the tax implication of that is the question which might come across, right? Now, when I say what is the tax implication, what do I mean by that? So let's say if I am a consultant and there is a company whom I am going to advise them over a span of time so that it has an appreciation of their price. Now, today, if I'm entering into an agreement with them, and because of that, I'm getting certain number of shares, then question number 1 is, at stage 1, what is going to be the character of that particular income? So that sweat which I got, that equity which I got at the first stage, what is going to be the character of that? That's point number 1. Point number 2 is going to be that what is going to be the treatment of it in the first place. So is it going to be taxed in year 1? Is it going to be taxed in year 10 when there's actual liquidation which is going to happen? That is second question which is there. Third question which is going to be there is whether there is going to be any gift tax. So whether that will be covered under section 56 or not. That's the third question which is going to come across, right? So let's take one by one. If I go to question 1, at the first day, when I am getting the preferential allotment as a consultant of the company, in my view, when I'm getting this particular shares, whatever is the value of the company on that particular day, at that particular value, it becomes my income. If I'm correlating that particular shares to my professional curriculum, then of course that will be considered as my professional income, and that should be accordingly considered in my computation. So that's one thing. Question 2, when we go to what is going to be the income when I'm going to receive it at this year 10, right? Now, what happens is year 1 we completed. Now we are going to year 10 when there is actual appreciation of it, and when I'm going to get more wealth from that particular startup company. In that year, what is going to be the treatment of it? So at that time, I will consider that this is my investment which I did, and after this investment, when I'm going to liquidate that investment, I'm going to get the money back in the year 10, and that's going to be my gain which I'm going to be receiving. Now, of course, one may say that yes, because this has been in relation to your profession income, and therefore it is not necessarily to be considered as gain. It should be also considered as business income or a professional income, because at the end of the day, you are receiving something for the services which you are rendering. I would not absolutely deny that particular fact, because yes, I'm actually getting the benefit as a part of my rendering of the services. But at the same time, what is equally important is that I'm making an investment into the company, and by and large, because of various factors of business model, etc., I'm getting the benefit of it. So there is going to be that factor which needs to be looked into before we take a final call whether I would take it as business or I would take it as capital gain, right? Then I move on to the third question of it, that whether it is going to be a gift tax, which is section 56, when I'm going to get the shares on the day 1. I don't personally believe, of course, it is open for discussion, but personally, I don't believe to consider it under section 56. One of the very important reason is because there is a commitment which is there as a part of, there's a contractual commitment as a part of which I'm getting this equity, and I am going to deliver it, and that's the only time when I'm going to get this whole thing. So there is an imbibe consideration which is there, and courts have also accepted this imbibe consideration. But of course, there has to be, and there is going to be a litigation on this front. But when we argue, when we contend this particular point, at that stage we always can consider that on the day 1, when this particular shares, when I have received it, it is received towards my professional commitment, and there is an imbibe consideration for that which is going to be accrue, and therefore at that this should not be a part of section 56 according to me, right? Now when we move forward, whether TDS is required to be deducted on equity to consultant at a section under section 194R as a perquisite. That's a new thing which has been there, where anything which is being given to the consultant beyond consideration in cash, of course, that is considered as a part of the perquisites, right? So here also, when you go for equity allotment, and when you are actually giving equity to the consultant as a part of their the services which they are going to provide, I am seeing that yes, this particular section might get triggered over here, right? Because there what you are happening is, as a consultant, he is going to get this as a perquisite, and he is going to offer the value of it as an income in the year 1, right? So that's something which needs to be looked upon and taken care of. Can the method of valuation be questioned by the AO even in a case of preferential allotment? So AOs, generally assessing officers, are questioning it, but when we go beyond that and when we go to courts have generally said that in such situations, if there are rationales which are there in support of the valuation, when the methodology which has been adopted are prescribed methodologies, and there are rationales which are given by the valuer for valuing at a particular value, then of course the questions can be on the rationals, but it cannot be on the methodology, is something which the courts have approved, and therefore one can take that note that questions can be on the rationals but not on the methodology, unless the methodology is something not within the framework of the valuation parameters. Now, going forward, whether ESOP discount is allowable in vesting period. yes, ESOP discounts. There's a Supreme Court on this, where Supreme Courts have. So what happened is, before Supreme Court, the revenue, which is department, had argued that while the ESOPs are under the vesting stage, right, it may not get exercised. So maybe I may not even go to vesting stage. I'm still at a grant stage. So when the grants is done and the vesting period is going to be there, at the whole span of time, right, whether this equity is going to be considered as uncertain liability, because revenue was contending that it's an uncertain liability, it is not a certain liability. So here the court, in the Supreme Court, what was approved is the observation of Karnataka High Court, where they said that it is basically a uh, it is a certain, it is basically a liability is certain. So there's going to be a payment which is going to be made. What is not certain is only the quantification of the amount, because at that stage might be that the value which is agreed at the grant stage might be different, and the value at the time when actual exercise happens might be the value is different. That is the difference, and that's a quantification matter. No matter as far as the uncertainty of the liability is concerned, the courts have said that it's a certain liability, and therefore that allowance is accepted over a vesting period. Whether SAR is taxable as perquisite or capital gain. Now, this was one of the questions we have discussed while I was talking about phantom, whether this will be considered as business income, whether it will be considered as salary, whether it will be considered as capital gain, right? So similarly, when we talk about SAR are basically stock appreciation rights, which I'm getting, right? So when I'm getting a stock appreciation rights, whether it's a perquisite, whether it's a capital gain, whether it's a business income, all these three things is going to be dependent on what is the nature for which you have got it. So if as an employment contract you are given SAR, then of course we all agree to it that it's going to be perquisite. When it is going to be in the form of business as a consultant, etc., when you're going to get in the nomenclature of that, then of course this is going to be a business income. And if you are getting it beyond that as an investor, which generally does not happen, but in case if you are receiving it in that format, then it is going to be a capital gain. Phantom, yes, I agree. Or not even not for phantom, but CSOP, I may agree. CSOP is generally where you might be as an investor, and therefore the question will be that at that point of time whether it is going to be a capital gain or not. But currently, as we didn't had clarity on VDA, and people were taking a stand, which of course now there is a clarity, but that stage, because there was no clarity, people were considering based on the character of their activities and transactions. So if they used to do it regularly, then they were considering it as business, and if they used to do it occasionally, then they were considering it as capital gain, as an investment. So same concept, we can buy from there, and we can adopt until we have a complete clarity on this particular part. I'm talking on CSOP. As far as SAR is concerned, salaried people, it is perquisite. As far as business people are concerned, of course, it's business income, right? Whether SAR is allowable on the year, sorry, just give me a second. Whether SAR is allowable in every year of appreciation, yes. So if we go with this principle of Biocon, Supreme Court, of this SAR, which is basically stock appreciation rights, again here there is a commitment, there is a certainty of the liability. What is uncertain is the quantification of the amount, and therefore in practice, there I have been seeing that people are taking it as allowance on a yearly basis as per the price adjustments which happens at the year end, and they have been making a provision for that, and they are claiming this expenditure. Uh, That's about SAR. SAR basically, if we want to claim it as an allowable expenditure on a year-on-year basis based on the appreciation of the price and the provision which we make into the accounts, then one may consider the support of Biocon as a principle which was laid down there, which is Supreme Court and Karnataka High Court. And there is a couple of more decisions in this particular lines which one may look into. So based on that, in my personal view, yes, the allowance can be made. Now, this is another concept in the startup world, which is basically valuation capping and discount capping. Now, what is valuation capping? What is discount capping? Let's spend some 2 minutes on that to understand this principle. Valuation capping is basically, let's say today there's a new startup and I am entering into the startup. I am not framing the valuation of the organization right now, right at the initial stage. I'm entering into the company. What is going to happen is that over a period of time, as the company grows and gets matured, and as the concept gets matured, there is going to be an investor who will come in, institutional investor who might get involved. Now, let's say if at that stage he arrives at a particular value, let's say X valuation, right? I entered at stage 1. This company, institutional investors are coming at this particular stage. So what is going to happen is there's going to be a gap. So there's going to be a capping. So whatever value at this stage when the company is going to enter into, at the initial stage, the startup company is giving me a commitment that I'm going to give you that capping, right? So I will make you equivalent to that particular stage so that you enjoy the value which institutional investor is going to give me. So that is a valuation capping. Now, when you on the same concept, there's a discount capping also. So if there's a discount which is going to be there, I'll be given a cap that beyond this, I'll not discount your price. And that's how the discount capping mechanism works, right? The question might be that at that stage, what is going to be the valuation to be considered for for the purpose of section 56. Now, let's say today I entered into an equity. I invested into the company with a particular equity at a particular valuation. So I am given that valuation. In the later stage, when an institutional investor is going to come in, again, there is going to be valuation and there is going to be some adjustments which is going to happen for my shares. So since there is a backup available for both the instances, therefore, I believe that that is going to be accepted by the income tax authority is what I understand. Whether investments in CSOPs allowed as deduction on redemption, in my opinion, it should be, because when I'm investing a particular amount, and over a span of time, I'm going to get the wealth generated out of that. So of course, the basic investment should be allowed as deduction is what I believe. Whether gift tax, that is section 56, will be applied on CSOP holder on allotment of shares. So when there is an allotment of shares, whether the CSOP holder will be liable for a gift tax, I don't think so. Reason is because I'm going to get the shares against some contractual agreement, and that is going to play a very important and vital role as a part of the consideration. Unless something fishy is being made, and if it is arranged, then the arrangement which is entered is absolutely not in the practical sense, then it's a different scenario. But if it is a very pure, genuine agreement arrangement which is entered, then I think that's backup which is going to play a very vital role for the purpose of defending section 56. Treatment for employee, broadly everybody are aware of, but I'll very quickly take you through that. What it says is, in the hands of employee, stage 1 of taxation is at the time of exercise. So when you exercise as an employee, when you exercise it, whatever is the exercise price on that day, whatever I am paying it to the company, so fair market value minus the exercise price is going to be a perquisite, which is going to be for me as an employee. Later on, when I'm going to go and sell those shares, whatever is going to be the price which I'm going to realize at the time of sell minus whatever is I have already paid tax at the time of exercise. That differential is going to be taxed in the year when I'm going to sell as capital gain, right? So that's the treatment as far as ESOP is concerned. This is one benefit which is given again to the startups. Government is very trying to be liberal to the startup world, and therefore there's one benefit. What was happening is lot of companies used to the employees of the organizations and the companies were had represented that at the initial stage when the startups are giving ESOPs, though because there is no hefty value and the employees cannot liquidate the shares, therefore there is a tax outflow in spite of the fact that the income is not accrued, right? Or income is actually not received. Therefore, there should be some deferment of taxation. That is what the representations were made by the startups, and that is accepted. So what government said, that for the eligible startups, so the startups which are having recognitions, for them, when they are giving ESOPs, there is going to be a time gap, right, for taxation. Now, how is that going to play a role is something which I've given here as a part of the example. You can take a snap of it, but that's what is going to be talking about. Now, let's take a case where the total income is 40 lakhs. Perquisite value of ESOP, okay, is 90 lakhs. Total income, of course, is going to be 1 crore 30. The total tax is 44 lakhs on this, including surcharge cesses. So 44 lakhs is the total tax if you consider ESOP on day one, right? Now, what is the liberty which is given? The liberty is that first year you won't be taxed on the ESOP. So ESOP will not be taxed in year one. You will be taxed only on the salaried income. So whatever calculation is which is required is done, but then proportionately only the tax is going to be levied on the salary portion, not on the ESOP portion, right? Now, when is going to be taxed this amount? So this amount is going to be taxed at the later stage when the employee resigns, when the employee encashes, okay, or in the span of 5 years, okay. So that is the time when this is going to be taxed, and this is how it is going to be taxed. So let's say 44 lakhs, out of which 13 is already taxed in the year 21-22, as in this example in year one, right? The balance 30 lakhs which is not taxed is going to be taxed in year 5, right? So that's how this whole treatment is going to be, and that's how there is going to be a deferment of taxation for the ESOPs for startup companies, employees of the startup companies. So that's whole about it. I'm done with my presentation. This is one QR code for one of the WhatsApp group which has been run where with a group of chartered accountants, all of us are actually sharing knowledge, making a concise representation of case studies, articles, etc. So one who is interested in getting a concise version of any articles or case studies can subscribe to this particular QR code and can get registered for this particular group. I think I am done with my presentation. Thank you very much. And I'm opening this particular floor for question and answers because my time was till 4 and therefore I'm on time to complete it. And we, of course, will have the question answer section. Thank you very much for, I'm seeing there are around 56 people, 56 participants who are there. So thank you everybody who have been participated, and whoever wants to have the benefit of this QR code can do that. And now we can take question answers, please. Thank you very much. Over to you, Komal. Komal?
Yes, sir. Sir, the questions are available in the question panel. Like
Okay.
Venkatesh Babu K has asked, what is the conversion rate we should use for calculating the capital gains, if any, for an equity given to employees?
What is the conversion rate? Can I just see the question? Just a second. Let me just see the question.
Sir, that is available in available at QnA.
Yes, I'm opening that. I'm opening.
Yes, sir.
There are some questions which are also there in the chat. We can take that too, but I'm first taking this. What is the conversion rate we should use for calculating capital gain if any foreign equity is given to employee? So, okay, I believe Venkateshwar, when you are asking conversion rate, I think you are talking about foreign conversion rate, mainly for conversion to Indian rupees for the calculation of capital gain. And I believe there is a specific rule which is there for this. According to the rule, there is a prescription which is there as to when you do the conversion, what is the rate which you have supposed to take. If I am not wrong, that is a part of rule 115 where this particular thing is available. You can check it out. In case if there is further query to it, you can of course come back to me on the email. The second question is, in case of trust, how to treat the residual amount, that is difference between loan amount obtained from company and value at which the entire trust holding is to be transferred. So let's say he has said that the loan amount is 1 crore and the fair market value of the trust holding is 1.3 crores. So here, Shriram, what is going to happen is, let's say if suppose a particular ESOP scheme is going to be, let's say is going to be subscribed, right? Now, let's say at a grant stage, you have arrived at a particular value. Now, at grant stage, if you have arrived at a value of 1 crore, taking your example forward, then there is going to be a loan which is going to be lent by company to the trust. Trust is going to be subscribing this particular shares, and once they subscribe, the employees are going to pay exercise price to the employee, to the trust, I'm sorry, and trust will repay this particular money to the company. Now what is going to happen is, if the exercise price is going to be less, let's say the exercise price is only 50 lakh or 70 lakhs, okay, which the employees have paid to the company, in that particular case, that 30 lakhs will still be remaining with the trust as a form of loan, because the company has taken a loan against, sorry, the trust has taken a loan against the number of shares which are issued or subscribed, right? So that 30 lakhs will continue to remain with the trust over a span of time till the whole ESOP scheme is getting completed. Once the whole scheme is getting completed, then of course there is nothing left into the company and under the trust, and the trust will have to reverse that particular loan amount. That's how the treatment is going to be played. If the parent company abroad gives shares to employees of subsidiary in India, okay, then what will happen? However, the shares will be exercise on future date, okay. Indian subsidiary has not taken any provision, okay, but parent company abroad has taken provision for this long-term investment plan for employees of subsidiary company in India. So Indian company has not made a provision. Of course, that generally does not happen. Indian companies are making provisions for it, because foreign company, based on the valuations of their shares, they are recovering by raising a debit notes on the Indian company. Let's say in this given case, if you have still not been charged by cross-charged by the foreign company, now you can ask them to cross-charge it, and you can make a provision for that in your accounts, and accordingly you can pay it. Of course, there is going to be a transfer pricing regulations which is going to hit over here, because the moment you hit to your P&L account, there's a transfer pricing regulations which is going to get triggered, and therefore valuation of the foreign company is going to play a very important role for the purpose of transfer pricing. Whether equity will be reduced by the TDS amount. So I think that is a kind of arrangement, or a scheme will take that decision as to how, whether they want to consider the reduced price or whether they want to overload that particular thing, is something which is the scheme which will take that decision. It's a commercial decision. Tax treatment of SAR issued by purchasing company to promoter of selling company. Tax treatment of SAR issued by purchasing company, okay, to the promoter of selling company. Let me digest this question. The question is, what is going to be the tax treatment of stock appreciation rights which are issued by the purchasing company to the promoter of selling company? Okay, okay. So, Shriram, can you please give me an understanding of tax treatment you are talking about is from the perspective of which company, selling company or purchasing company? Because for the purchasing company, this is going to be a cost, right? So, and this SAR, if suppose there are only SARs which are issued, okay, so as in how the appreciation happens in the price, you will be making provision for that, and you will be accounting in your books as per the guidelines notes which are there and as per the accounting standards. When you go from the promoter's perspective, in the hands of promoter, today he is not receiving anything on day one, because in SAR what happens is day one you don't get anything. When there is an appreciation in the price, that at that stage you get the benefit of it. And therefore, if we look from the promoter's perspective, who is going to sell, who is selling the company, in that particular case he will be going to tax, he will be taxed in the year in which he realizes the amount, right? That is the year in which he's going to get taxed. So I think that answers your question from both the side, from the company side and from the promoter side. Let me go. Are there many more questions to it? Can you share WhatsApp group link in chat? Okay, let me do that. Just give me a second. Just give me a second. I'll do that. Sorry, I'm not been able to do that right now, but if I'll just, there have been, I'm seeing some people who have already joined. So if they can do it, it's better for the group to get registered for it. But taking the next question forward, I think the next question is whether deduction of discount is to be computed based on share value on grant date. Whether deduction of discount is to be computed based on share value on grant date as recorded in books, or share value on exercise date, that is fair market value on the recognized stock exchange, in the income tax computation of employer. Let me read once more, just a second. Whether deduction of discount is to be computed based on share value on grant date, okay, share value on the grant date, or share value on the exercise date in the Okay, so I understood your question. I think if I understand it correctly, your point is that how is I'm going to record it in my books on a yearly basis, and how am I going to get the deduction of that? I think that's what you are trying to ask. At the grant date, you will arrive at a particular value which you might fetch, which you might have it over a span of years from for the vesting period, and on the exercise date, so whatever value you have arrived at, based on your projections, etc., so that value minus what is going to be the exercise price, that is going to be what you are going to allocate it over the years, and that's what you are going to claim it as a deduction. So that, I hope, answers your question, Rajnikant. Let me see if there is any more questions. Just a second. Yeah, there's one more. During the closure of trust, what if the trust is having excess amount? That is, buyback price of the company is more than the purchase price from the employee. So yes, that's going to be there, because the trust, when they have subscribed it, the price are going to be higher than what the employees have paid for it. So at the later stage, whatever amount which is lying back with the company, with the trust, they will repay that particular amount back to the company. So for example, let me answer it. Let's say 1 crore of rupees which was there as a part of initial discussion, 1 crore of rupees which are there with the trust, which is lended by the company. Now, based on the scheme, the trust is going to subscribe to those shares, right? And the ESOPs are going to be given to the options are going to be given to employees. Now, employees will repay certain amount to the trust for subscribing to this particular shares. Let's say out of 1 crore, 30 lakhs is something which the people have given back to the trust, right, as an exercise price. Now, there was already 1 crore which was available with the trust. Trust have subscribed over a period of time. Now, employee has repaid certain amount to the company. So what is going to happen is trust is first going to repay the loan amount which is there, to the company. Now, let's say if there is some excess which is left with the trust. Now, that money can be utilized based on the internal procedure resolutions, etc., for the further schemes which the company may come up with. If not, then company will give back this money to the trust will give back the money to the company, because it is absolutely with that objective where the trust was formed. So if they are going to utilize it for further schemes which are going to come up, then they can use it. Otherwise, they'll give it back to the company. I think that, is there anything more? Let me check. No, so there is a link which Rajendra Somani has shared. Thank you, Rajendra, for sharing it within the group. But I think I'm done with all the questions, at least in Q&A part. Let me check if there is anything on the chat side. So on the chat side, I think PPT is not shared, which will be shared to you guys. Sir, what is the conversion rate? I answered it. If parent company abroad gives shares to the employee of subsidiary in India, what will happen? How the shares will be exercised on the future date? Indian subsidiary has not taken any provision. I think I have answered this question. Then I think, yes, Bharadwaj has given a thanks. Thank you, Bharadwaj, for giving me that, acknowledging it. I think that I am done with all the chats also and question answers also. Thank you everybody for giving me those likes and acknowledgements for this particular event, and